Introduction. Speculation in financial securities is referred as day trading. This concept is usually referred to when trading of financial instruments such as their buying and selling takes place in a single trading day. In a simple manner, day trading is trading of financial securities or instruments within a single trading day. It is done in such a way that all related positions should be closed before the market or related stock exchange closes that particular trading day. However, not every trader is strict enough to follow this strategy or concept with pinpoint accuracy. Still, there are significant numbers of traders involved in stock trading who follow or implement concept of day trading. Chapter 1. Characteristics of day trading. Scalping is an intraday technique used by some day traders. In this technique, traders usually hold a particular position for a few minutes only. Sometimes this time span is even of seconds only. Positions are left by most of the day traders just before the market closes. Doing this, traders avoid the damage of unimaginable risks. These risks are usually the negative gaps between price at current day's closing and the price at next day's opening. However, these gaps sometimes are positive too. That is why some day traders prefer to stay in a particular position even after the market closes. Such day traders believe that they can keep the profit running by doing so. As described before, margin trading is an important concept that helped in the process of making day trading common for every trader. In day trading, when day trader borrows money from other party to invest in trading, it is known as margin trading. In such trading, the trader is required to pay no or nearly zero fees for margin benefits. It is because margin interests would be usually charged on overnight balances, since the money is borrowed for a single day only and most commonly returned by the next day. Still, trading is the second name of risk. There is no market without risk. Just like that, margin trading too is not completely safe. There is always a risk of margin call. Margin interest rates are part of such margin trading. These rates are usually based on broker's score. There is rarely an exception. Profit and risks. Day trading results have a wide range starting from extremely high returns and extremely high loss. Financial leverage behavior and possible rapid returns are reasons behind such instability. There are several possibilities involved in such trade. High-risk day traders are likely to end up either with huge returns or loss. The result can be anything in between these two boundaries. Since possibilities of high profits and losses are involved in day trading, other investors refer to day traders as gamblers or bandits. Risk involved in day trading is even higher if any of following aspects is present while trading is taking place. When trying to trade a loser's game or system instead of attempting on at least a winnable system or game. When capital risk is inadequate with excess stress of having some to survive in upcoming trading. If traders are executed poorly, poor guy would be even poorer. If money management is not done competently. Gains and losses are amplified by the common use of buying on margin. As explained before, funds are borrowed for trading in margin trading. In such trading, loss or profit can occur within a comparatively short period of time in a substantial amount. Moreover, to take maximum possible advantage of such day traders, they are allowed with bigger margins by most of the brokers since interest rates are based on broker score. Let us explain this term with a quick example. In USA, in order to hold a stock position overnight, margins are required to be at least 50% of value of the stock. Despite that, pattern day traders are allowed by most of the brokers to keep these rates as low as 25% for intraday purchases only. This ultimately means that a day trader who legally has $25,000 in his account will be allowed to purchase stocks worth $100,000 as long as he leaves half of these positions before the trading day is closed by the market. As one can clearly see, The loss margin is freaking high. Thus, most of the day traders have to leave the positions quickly, even if they are losing ones. They have to do this because it might lead them to even greater and totally unacceptable loss that is even a disastrous one. Such a loss can even be greater than his investments or even more than total assets owned by him or her, if you know what will happen then. Chapter 2. Financial History and Settlement. Most of the important stocks in the United States were originally and basically traded in NYSE, or call it New York Stock Exchange. The system was quite simple. A trader willing to buy stocks would contact a stockbroker in order to, setting up the deal. Most of these brokers relied on specialists operating from floor of the New York Stock Exchange. Each of these specialists is allocated only a handful of stocks. If required stock is not in their scope, the specialists would redirect the potential purchaser to some other seller of the same broker. Once the deal is discussed, very quickly though, tickets are written and processed. Once done, stocks are effectively transferred. The information is reserved back to both brokers and purchaser as confirmation. When this system was used, brokers usually fix their commission somewhere around 1% on the total amount of stocks traded through their reference. For instance, if someone purchases stocks worth $10,000, the brokerage commission would be $100. The brokerage rates were same for selling the stocks too. It means that 2% of commission is given away to brokers in complete process of trading stocks that includes both purchasing and selling. It clearly indicates that there would be no real profit unless the return rates are higher than 2%. It means if one gains 1% returns, he is actually in loss with the same rate. Day trading was not possible in such systems since making decent profit was quite hard. However, as the commission scheme was changed, doors were opened for day traders since it became possible to snatch some profit through day trading. In 1975, SEC, United States Securities and Exchange Commission, declared that fixed commissions rates would no more be legal. It forced brokers to offer discount and also for reducing their commission rates to stay in competition with others and keep up the same pace as they used to do in the old system. Financial settlement. Period of financial settlement was much longer than it really seems to be. In 1990s, London Stock Exchange, LSE, allowed the payments to be done after as more as 10 days from stock purchase. It was much of an advantage for a trader. They could simply invest in stocks with no money in hand. They used to simply buy the stocks and keep them for 10 days or until their deadline for payment, hoping that price would rise before the payment period ends. If price rises, they simply sold the stocks with a profit in hand. Even if the price does not increase, they still sold two stocks with small or no loss and required to pay only the loss instead of full stock amount. Clever guys. This kind of trading seems very similar to modern long-term investment trading, since loss and profit scales are limited in both of them. However, settlement time was much longer for such old-school trading. Situation has changed a lot in modern stock trading. Settlement time is not as short as 3 working days, so that market risk can be kept as its minimal. Reducing settlement period also reduced likelihood of defaults along with reducing risks. However, it could not have been possible without electronic ownership transfer. This system was implemented by most of the stock exchanges using electronic communication networks. These terms are discussed in upcoming chapter more descriptively so that you get an idea about how exactly it was done. Chapter 3. Electronic Communication Networks. Stock trading platforms, or say systems, are constantly being evolved since when they were introduced. In second half of 20th century, stock trading systems were evolved enough to adopt electronic communication networks, ECNs, with no problem, making the concept of electronic ownership transfer practically possible. ECNs, or electronic communication networks, are massive proprietary computer networks. Here you should notice that they are compulsory required to be massive and gigantic to handle a load of massive stock trading. On these networks, brokers are allowed to list various securities that they want to sell. Amount of these financial assets and their price is predefined. These prices are also referred as asking price or just ask. This listing system is as well used for offering certain amount of stocks to sell at a certain price. This price is referred as bid. 3 or 4 letter designators are assigned to ECNs and exchanges so that trades can identify them easily. These designators are also displayed by the ECN or exchange on level 2 stock screens. Instinet or INET was first of such. It was founded in the year of 1969. Intent behind developing it was for ease of some major institutions. These institutions or organizations could use it in order to avoid being dependent on quite expensive and slightly unreliable NYSE. This system enabled them to work during time even when stock exchanges were closed. In beginning period of ECN, they were not that friendly for smaller investors. These early ECNs, such as Instinet, offered comparatively better prices to large institutions compared to what they gave to a smaller one and to common public. These systems often led entire stock market to illiquidity and multiple fragmentations. Nasdaq was established in the year of 1971. After the foundation of Instinet, Nasdaq is considered the next major step in the process of facilitating day trading. Nasdaq was quite a bit more than a simple ECN. It was a virtual stock exchange with all the functionalities that a physical or original stock exchange possesses. In this virtual stock exchange, orders and transactions were transmitted electronically. However, things here were not as simple as they were during implementation of ECN. Nasdaq intended to move the market from paper or written share certificates and registers to dematerialized or virtual shares. It intended to implement computerized trading and computerized registration on a whole lot of vast scale. For achieving these results, significant development in technology and major changes in legislation were required. Batch systems were useless in this process. Online systems that can operate on real-time speed were required. This was not it. Postage services, telex, and physical shipment of computer tapes were replaced by electronic communications. For implementing such major changes correctly, major and secured cryptographic algorithms were developed. And finally, the idea of virtual stock exchange became possible. Market makers got their appearance heralded thanks to these major changes in traditional systems and developments or advancements in technology. A market maker is simply equivalent of NYSE specialist. The only difference is that he is a specialist of Nasdaq rather than New York Stock Exchange. Inventory of certain stocks is held by a market maker in order to buy and sell these stocks. He eventually makes offers for buying and selling same stocks. It is certain that these market makers too require a profit. So it is definite that they will offer a selling price that is higher than the price for which they bought the stocks. This difference between buying and selling price is known as spread. Ultimately, market makers do not have to worry about the stock rates if it is going up or down. Since these market makers are always trying to sell the stocks at a higher price than at which they are offering to buy it, simply giving no space for loss. However, it does not mean that they never go in loss. If they keep their trend persist in a single direction, it will eventually lead them to loss. However, their overall strategy is positive and always leads them to profit regardless it being major or minor one. If it wasn't, they would have moved out of business long ago. Talking about current situations, there are around 500 firms playing their role as a market maker for various ECNs. Each of them form a market that encompasses as low as 4 and as more as 40 different stock markets within it. These market makers were allowed for offering much smaller spreads on electronic communication networks compared to Nasdaq. In this system, the difference between major investors and minor investors was persisted. For instance, a small investor was charged with $0.25 spread, and a major institution was charged only $0.05 spread. For example, the minor investor would buy stock at $10.50 and get $10.25 for it. On the other hand, an institution would pay $10.50 for a stock and get $10.45 upon selling it. The final revolution in field of financial trading took place in the time span between 1997 and 2000. These 3 years might sound shorter, but brought some major changes in this field. This period is known as technology bubble. It will be broadly discussed in upcoming chapters. Chapter 4. Technology Bubble. SEC decided to adopt order handling rules considering stock market crash in 1987. According to these rules, market makers were required publishing their bids and asks on Nasdaq. Another rule set was implemented under the name SOES, standing for Small Order Execution System, according to which if market makers want to buy or sell stocks less than 1001, they are required to do so at their listed bid and ask prices. This system triggered rise of some small group traders called SOES bandits. What these people did was buying and selling small orders of stocks to market makers before the actual prices are listed in order to snatch a decent profit through it. Thanks to SOES system, traders started assuming software more facilitated compared to market makers or electronic communication networks. By late 1990s, ECN's market was completely broke down since the implementation of SOES system. To keep their existence, most of the electronic communication systems started offering their services to smaller investors. There were many new brokerage firms established in that period. These firms were expertise in serving online traders who still wanted to trade on ECNs, making situations for ECNs a little bit creepy. Major new ECNs such as Archipelago or ARCA and Island or ISLD were also established in that period. Eventually, Archipelago managed to be accepted as a stock exchange. NYSE offered merging offer to Archipelago, which they would have delightfully accepted. However, this could not happen since resistance was rose by some members of New York Stock Exchange. In the year of 2005, NYSE ended up purchasing Archipelago Stock Exchange, ultimately plummeting the commissions. Here is a quick and quite extreme demonstration. Let us consider an online trader is buying $3,000 worth stock in the year of 2005. He paid commission of around $10. For same stocks, he would have paid commission of 3,000 USD back into the year of 1974. To make situation clearer, in 2005, the trader was able to buy the stocks within an instant and for a comparatively cheaper price. By that time, ECNs were constantly in a flux-like situation. In this period, many new ECNs were formed. On the other hand, most of the existing ones were either bought or merged by major stock exchanges. As the year of 2006 came to an end, following major ECNs to individual traders were there. Instinet. They bought Island 4 years ago in 2002. Archipelago. However, it is bought by NYST and technically is an exchange, or a part of one, rather than an ECN. The Brass Utility or BRUT. The Super.ECN that is now superiorly used by New York Stock Exchange. There were multiple factors and combinations of theirs, thanks to which day trading has become practically possible in stock exchanges and stock derivatives. Thanks to lowered commissions, small firms or smaller individual investors can now make multiple trades during a single day. Favorable profit can be snatched through quick trading provided by ECNs that get completed in an instant. Decreased spread and liquidity have also played a major role in this process. Spreads for high-volume issues such as Intel or Microsoft is as small as $0.01, so that all it takes a change of few pennies in price for a trader to cover commissions and grab some profit. Extreme bull market in technological issues during 1997 and 2000 stretched capabilities of individuals for day trading even wider. These issues are known as dot-com bubble. During these 3 years, Nasdaq jumped 1,200 to 5,000. This was a period in which multiple newbie investors with zero market experience jumped in and made significant amount of profit by simply investing into stocks in the morning and selling them in the afternoon for 400% returns or margin rates. Unfortunately, this bubble burst in the month of March in 2000. Nasdaq crashed from 5,000 to 1,200 once again. Many inexperienced traders lost money much faster than they got it during this period of buying frenzy. Despite of it being possible to make fortune in that period by shorting or playing upon volatility, many small and inexperienced traders completely broke down. Stock trading began to rise by the end of 1990s. Along with them, many market makers used electronic trading platforms for providing foreign exchange and derivative day trading. There were multiple benefits for day traders from such platforms. They got access over decentralized markets such as forex trade and also over global markets such as contract for difference through derivatives. In beginning, most of these first were UK-based. Later on, US started restricting or prohibiting such activities involving over-the-counter trading. It caused these firms to move somewhere else where restrictions were a little to zero level. Trading on margin was provided by most of these firms. With such platforms, day traders were allowed to take over a large position with a comparatively small capital. However, with this ability came the increased associated risk. Talking about such famous platform, retail forex trading is famous among day traders thanks to the liquidity they provide. Moreover, it possesses a 24-hour market nature. Nowadays, it is quite a convenient way for day trading with small capital. Chapter 5. Techniques of Day Trading. In this chapter, various strategies are covered that are basically used by most of the day traders in order to cover profits. Other than these basic strategies, some day traders apply reverse strategies. These reverse strategies are also known as contrarian strategies. Such reverse strategies are most commonly used in algorithmic trading. By using such contrarian approaches, day traders attempt to trade against irrational behavior. Whatever technique these day traders apply, they have to make sure that their approach is flexible enough so that their techniques can be adjusted according to necessarily as required. Since the marketing conditions change constantly, traders should always be flexible to get settled in any condition. In some of these approaches, shorting the stocks is required instead of buying the stocks. In such approaches, stocks are borrowed by the trader from a particular broker, expecting that prices would drop so that he can purchase those shares at lower price. In such approach, there are a number of problems since shares are short sold instead of directly buying them. Broker have total complete over the process so that if he doesn't want to lend share for certain issues, he can call the lend shares back at any particular moment. Moreover, there are some restrictions on such approach in America. United States Securities and Exchange Commission have put some restrictions over short selling of such stocks. However, if the stocks are share of exchange traded fund, ETF, many of these restrictions do not apply on trade of such trades. Trend following. Strategy of trend following is used in almost any time frame. In this approach, it is assumed that if value of a financial instrument such as stock or bond is increasing constantly, it would continue to rise. If the value is constantly falling, it is assumed that it will continue to do so. If a trader is following trend-following approach, he would buy an instrument that had been rising constantly. The same trader can also short-sell a constantly falling financial instrument. There is only one assumption that the trend will continue regardless it being positive or negative. Contrarian investing. Like trend following, contrarian investing approach can also be applied in all trading time frames. However, it is a market timing strategy. In this approach, it is assumed that a price of financial instrument which is constant will start to fall constantly, and the one falling will reverse and start rising constantly. A trader following contrarian approach would buy a financial instrument that has been falling constantly. He may also short-sell constantly rising instrument, hoping that the trends would change soon in reverse manner. Range trading. Range trading is also referred as range-bound trading. In this approach, trader watches stock that are rising off a support price or that are falling off a resistance price. It is assumed that every time a stock hits a high, it falls back to low soon. It is same for opposite case. If a stock falls suddenly, it would be high and stable again soon. A stock following such behavior is referred as trading in a range. This technique is exactly opposite of trending. In this approach, the trader would buy stocks at or near the low price. He then possibly short sells at quite a high price. In a similar approach, stocks that are going out of their range are observed. This approach is referred as breakout if price goes up and breakdown in opposite situation. In both of such situations, it is assumed that if price has broken down the range, it will continue to move in that very same direction, up in breakout and down in breakdown, for a decent amount of time for grabbing profit. Scalping. When technique of scalping was evolved, it was completely based on spread between two prices. Thus, it was known as spread trading. In this approach, trader exploits small gaps between ask and bid listings of a particular stock. In this approach, position is established and liquidated quickly within minutes or even seconds. By applying scalping technique on highly liquid financial instruments within a single day, traders can snatch significant return when keeping the risk at its minimal. Many technical analytic concepts are involved in this approach, such as over or underbought, support and technical analysis, trend line analysis, trading channel, small move analytics, etc. This technique is of great use when inefficiency of the market increases and trading range expands either positively or negatively. Fade technique is also a part of scalping approach, in which if a stock has suddenly rose and seems overvalued, it is quickly short sold by the day traders. Rebate trading. ECN rebates are primary source of returns or profit in this technique. It is an equity trading style. Commissions are charged by most of the ECNs to customers if they want to get their order filled instantly with the best prices available. However, commission is paid by the electronic communication networks to those customers who place limit orders. Limit orders contain less than 1,000 individual stocks. Such orders help to create market making and security. Trader following rebate approach seeks to make profit from these small rebates. They usually maximize their profit by trading or investing in low-priced shares. Despite the price being low, they are traded in comparatively high volume, maximizing the profit. By doing so, they can trade shares in more amount and increase the contribution in liquidity, that too with a set amount of capital. In such approach, risk is minimal since they cannot exit a position. News playing. This is quite a simple strategy based on news announcements. If a stock has announced good news, news player would buy those stocks. In opposite situation, when bad news comes, stocks are short sold. Such news greatly affects stock, providing them volatility. Situations are created for quick profit and losses in such circumstances. Price action of stock helps in determining if the news is really good or bad. Sometimes tone of the news is completely different than market reactions. It is much likely the news you heard are in fact rumors spread at market and industry analytics even before the official announcement. In such situation, market reactions would go opposite than the news. However, when the announcement is official, the price movement will depend on how well or bad the news is in terms of current market situations and was it its impact on absolute terms. Price actions. When trading stocks, there is no requirement of playing various complex strategies when it is more effective to keep the things short and simple. A form of technical traders is there following this simple technique. They are referred as price action traders. These traders do not depend on conventional indicators for deciding to trade or to not. They simply follow technical analysis for such decisions. A combination of various analytics is used by these traders, including price movements, chart patterns, volume, and raw market data. All these factors are considered for deciding if they should trade or not. This is considered the most simple or minimal approach in stock trading. However, it does not mean that it is even a bit easier than any other approach or technique of day trading. One needs proper understanding of market trades and some core principles lying within a market. A simple advantage of this methodology is that it works in all circumstances in any existing market, including stock exchange, foreign exchange, futures, gold, oil, etc. Artificial intelligence. According to dependable estimation, most of the major trades in the United States were generated using automatic algorithms or high-frequency trading in the year of 2005. Use of algorithms and quantitative techniques is constantly rising, constantly increasing competition and chances to snatch smaller profits with minimal risks. Chapter 6. Costs. Following costs are involved in concept of day trading. Commissions. Direct access brokers are paid commissions on the basis of stock volumes. The commission becomes cheaper with rising share volumes. It means that the commission of direct access brokers would be much less when stocks are traded in high volumes. Average direct access broker commission per trade can be as low as $5. This commission is for a round-trip trading, which means for getting in and out of a position. However, commissions for retail broker are not calculated on trade volumes. A retail broker can charge around $7 per trade, where the size of the trade or stock volume does not really matter. For a typical direct access broker, per share commissions are in between $0.01 to $0.0002. It means that particular broker would get $10 to $0.20 per 1,000 shares traded by them. Even a scalper trader can cover these costs with a small return. Spread. As described in previous chapters, numerical difference between in-bid and ask rates are known as spread between bids and ask. Bid-ask system is widely applied in worldwide markets, as prices are immediate market prices for buyers willing to quickly buy the stocks, where bid are real-time or market prices for sellers willing to quick sell their stocks. If someone executes a trade on listed prices, he will not definitely want to close it instantly, since the loss is definite in such situation. Since the bid price is higher than ask at any point, so quickly closing a trade would cause loss only. Many traders and market experts refer to bid and ask rates as two sides of a coin. It is also seen as trading bonus and cost according to circumstances for different parties and according to different strategies. Ultimately, spreads are paid as costs by the traders who do not want to queue their order and choose to pay market price. On the other hand, spread is a bonus paid to traders who are ready to queue their order and wait for the execution. Many traders attempt to capture spread as additional return. There are also some traders who manage to capture spread as the only and significant profit using proper strategy. Market data. Real-time market data is necessary for day traders. The data available for free by exchanges is usually 10 to 60 minutes late. Respective stock exchanges demand certain fees in order to provide real-time feed on market data. These fees are usually included in brokers' charges. However, it is not a thing to worry about since these fees are comparatively low compared to cost of trading. These fees are sometimes waived as well, intending for promotional purposes so that customers can meet a predefined monthly volume of trades. Meeting these requirements is not that hard. Even a moderate trader can easily meet them for getting free real-time data feed on market changes. Talking about raw market data, there are some heavily active traders who pay more for purchasing advanced data feeds. These feeds cover historical nature of market and are also capable of covering large range of stocks. They represent stability and instability of market in real-time speed. Some complicated charting systems and analytics tools are also some example of such advanced systems. These tools can cost from $10 to $100 monthly for attaining access. Chapter 7. Regulations and Restrictions. Day trading is quite risky compared to most of the trading styles. Essential regulations are required so that brokerage firms confirm if the traders, which are their clients, are aware of risk involved in day trading or not, and also if they have prior experience of market before entering or not. Pattern day trader. To make day trading more neat in United States, Financial Industry Regulatory Authority and SEC applied restrictions to prohibit pattern day trader amendments. SEC gives proper definition for the term pattern day trader as following. A pattern day trader is a day trader that sells any business security within a day and repeats the same cycle 4 or more times in a business period of 5 consecutive days. Special rule sets are applied over day traders. He must maintain balance of $25,000 in his trading account. It is noticeable that these requirements are applied only on those traders using margin accounts.